Hello, my friends. Today is February 17th, and this is Markets Weekly. So this past week, we saw the S&P 500 again make a new all-time high, but we did close the week down a little bit. It looks like the equity markets are having some problems with the higher than expected inflation prints. So this week, we're going to talk about three things. First, over the past week, the big data we got was a number of higher than expected inflation prints, and it seems like inflation may potentially be rising again. Let's talk about the data. Secondly, so we've been talking about the S&P 500 making a lot of all-time highs. Let's look beneath the surface and see what might be driving that action, and also zoom out a bit and notice that the equity market boom is not just US specific, but it's something that's happening in other countries as well. And lastly, I want to talk a little bit about GDP and GDP per capita. I saw some headlines of Japan falling into recession, and I think that's the wrong way to look at that, especially for a country like Japan. So let's talk about why GDP per capita may be a more relevant measure of performance going forward, especially in aging countries with aging populations. Okay, now starting with the inflation data. So just to level set a little bit, over the past 2 years, we've had very high inflation, CPI as high as 9%, that has very clearly been moderating. So over the past 6 months, looking at the Fed's favorite measure of inflation, core PCE, we can see that inflation, core PCE, has been at 2% for the past 6 months. And so from my perspective, I think the Fed already achieved soft landing. The question was, is inflation going to resurge, or are we going to tumble into recession? And as you all know, my view has always been that inflation would resurge, but not now, later on in the year. However, the data prints that we got last week were undeniably hot and seem to suggest that maybe inflation is resurging now. So the first inflation data we got was CPI. Now, CPI measures consumer prices, and CPI month-over-month core was 0.4%. If you annualize that, you get to a number that's above 4% on an annual rate. So, it's without doubt a high print. Now, the key driver of this hot CPI print was the shelter component, which is basically rents. Now, many people have been expecting shelter inflation to gradually moderate, because when they look at leading rent indexes, say those from Zillow, they can see that rent inflation has been moderating significantly over the past few months. So this jump in shelter inflation was a surprise. However, looking at the other components in the CPI index, you can see that broadly it wasn't just shelter, it was broadly a hot print. You can see medical services heating up, and you can also see food inflation rising as well. So this was without doubt a hot CPI print. Now, the second inflation data we got the past week was much less well known, but also notable, and that's input prices. Now, input prices, again, it's third tier data at best, but it was also higher than expected. Now, the third piece of inflation data we got the past week was on Friday, and that is PPI. PPI measures prices that businesses pay, and PPI was, without question, hotter than expected across the board. So it was a print that surprised the market. And the market's reaction to these prints was, of course, for bonds to sell off, although that reaction for CPI was temporary, but for PPI seemingly more lasting. Now, a reason for that could be because PPI feeds into PCE. So among the inflation indexes, the Fed cares about PCE. Now, if you know CPI, if you know PPI, you can get a pretty good estimate as to what PCE will be when it comes out. The big banks have looked at the data and run their own numbers, and they are estimating that PCE will come in at about 0.4% month over month, which again, if you annualize that, you get something above 4%, which is far above the Fed's 2% target. So the data we're getting shows that, we're hitting into some lumpiness in the disinflation narrative. Now, to be clear, this was always expected. Disinflation is very unlikely to be smooth. But then now it's an open question as to whether or not we're hitting into just some temporary bumpiness in the ride towards 2%, or are we at the beginning of a new trend where maybe we either trend higher or stay around here? Now, the equity markets, of course, don't like this because when they see higher than expected inflation, then they begin to think that maybe the Fed is not going to cut as quickly and as much as as had been expected. Now, recall, just a few weeks ago, the market was pricing in as many as 7 rate cuts this year. That's ridiculous, of course. But as of Friday, it looks like the market is just pricing in 4. And this week, I will write about what I think the Fed will do in reaction to this data going forward. But this is definitely going to be a market mover, so we have to pay close attention to how the data evolves. Okay, second thing I want to talk about is, of course, the equity market. So, as you all know, since December, I've been writing about the potential for a crash up, and I've also told you that I'm really cautious right now. So, the equity markets have been relentlessly marching higher in the US. And from my read, it seems like, well, okay, first, the macro backdrop is, of course, positive for equities, as I've talked about before, but it seems like there's a lot of speculation here, especially through options. So there's this good data from Spot Gamma, who specializes in these option things, and their data is showing that there seems to be a lot of interest in buying calls. So there's a lot of people buying calls, and that seems to be pushing the market higher and higher. Now, the way these things work, as I understand, is that after every options expiry, there is less hedging that market makers have to do, and so there's more freedom for the index to move around. And we just had an options expiry on Friday, and so maybe there'll be more volatility going forward. But when you have a lot of movement upwards driven by options, it can be very volatile. Let's look at Supermicro, for example. As we all know, this is an AI darling because the company makes servers that are needed for AI companies. And the stock has basically rocketed higher, and in large part due to a whole bunch of people buying calls and pushing the stock price higher. And it's gone to the moon, just like GameStop not too long ago. But when you have these large surges higher, they tend to be fairly volatile and fragile. And so on Friday, we saw just in one day, the stock dropped by 20%. So if you see a lot of upward pressure in any asset due to options, you should know that it's a fragile thing. So it's something to be cautious about. Again, I remain very positive on the equity markets. It's just that nothing goes up in a straight line. But let's zoom out a little bit and look across the world. So across the world, what you'll notice is that, let's say Japan, the Nikkei has been on a tear and almost at its all-time highs that it hit a few decades ago. So sometimes the stock market can go down and not go up for decades. It happens sometimes. It's not always up in a way. So, but anyway, in Japan, things have been going very well for the stock market. And if you look at Germany, let's say the DAX, you can see the DAX is at all-time highs as well, even as the German economy stagnates. So when I think about what drives equity markets, I think the most important thing, of course, is public policy, particularly central bank policy. So we are engaging upon a global rate cut cycle, and I think the equity market is reacting to that as well. So this is something that I think is probably going to continue going forward. But I think it's useful to know that what's happening in the U.S. is not special to the U.S., although the U.S. markets do seem to be stronger than other markets. Now, one other thing to note is that when people analyze equities, they often like to tie them to things like economic growth or earnings and so forth. But Japan falling into recession, Germany stagnating. So it's important to be able to look at things clearly and not necessarily take at face value what we often read in textbooks. Okay, now the third thing that I want to talk about is GDP growth and GDP per capita. Now, I saw a headline the past week about Japan tumbling into recession because technically their economy has contracted for 2 consecutive quarters. Now, on a broad level, so GDP is the amount of goods and services a country produces in 1 year. And if you produce, if you're producing a decreasing amount of goods and services on a quarter-over-quarter basis, they think we describe the economy as falling into recession because you're not producing as much. So how do you produce more goods and services? On the one hand, you can add more inputs, that is to say, have more people, maybe work longer hours, or you can be more productive. So you can say, take the same amount of inputs, same amount of people, same amount of materials, and just use them in a clever way through technology and be able to produce more. So to get higher GDP, you need more inputs or you need more productivity. So I think it's not useful to look at Japan and say it's falling into recession and so forth, because what's happening in Japan is basically what is happening throughout the Western world is that population is declining. In Japan in particular, their population has been declining for decades. Now look at this chart of their working age population. You'll see that it hit its peak quite a while ago and has really, really declined rapidly. At the same time, the US working age population steadily rose, looks like it's plateauing and will likely tip over in the coming years. So if you have an economy where your working age population is declining, you're just not going to grow at the same way. In fact, it should be expected that you produce fewer and fewer goods and services. That is to say, your GDP declines simply because you have less people. Now, that may sound alarming, but I think what matters when it comes to living standards is not GDP, but GDP per capita. That is to say, how many goods and services do we produce on a per person basis, or how much goods and services does each person enjoy? So if you look at GDP per capita for Japan, you get a very different picture. Now, their GDP per capita, it's not growing very quickly, but it continues to grow. So even as their overall GDP may be contracting, that could largely be due to changes in demographics. And so you can have a country with a shrinking GDP, but where living standards for each person continues to increase. And that appears to be the case in Japan. Now, going forward, this is going to happen to the US, and it's also happening to the Western European countries already. So we have to be careful, though, not to think too much about a declining GDP, since that's just demographics. Now, there are some countries who are, importing significant amounts of immigrants because they see their population declining. And that is, keeping their GDP growth steady. But that doesn't necessarily mean that on a per capita basis, the well-being of their citizens is improving. For example, let's say a country imports millions and millions of very low-skilled labor, people who don't speak the language and can barely read or write. Now, simply by importing these people into their country, the GDP for that country is going to increase. Why? Well, these guys, they're going to do something, right? They can wait tables, mow lawns or something like that. So they're producing goods and services, and they are contributing to the country. And so the size of the GDP increases. But also note that these people, they're going to use medical services, roads, schools, and so forth. And so they're very likely going to take from the public more than they put in. And so at the end of the day, there's going to be fewer public services and goods and services available on average to everyone. And so your GDP per capita would decline even as your overall GDP increases. And we see this happen in some countries who have experimented with mass migration, where their GDP per capita has basically been stagnant for some time, even though their overall GDP has increased. So going forward, I think we should have a bit more refinement in how we look at this. I'm not sure that it affects policy just yet, but if we are aware of it, maybe eventually the people will be more, we will see it talked about more, and that might influence policy. Okay, so that's all I prepared for today. Thanks so much for tuning in. If you're interested in my latest thoughts, check out my blog at fedguy.com, and of course, my courses at centralbanking101.com if you're interested in learning about markets. Talk to you all soon.